if we want more copper, if we want more nickel, we want more lithium, we need more rare earths, it's going to come from the third world. Well, they're going to use more energy when that happens. And so that's the big argument why I think this goes into the 2030s. And I think before this is over, we will see the price of crude oil trade above the 147, which is what we did in the summer of 2008. So I'm very, very bullish.
And here we are, another episode of the Kinvestor Report. I say the same. I'm Arlen Hansen. I'm the host. And this is where I talk about the market, commodities, stocks, and the economy. Today's guest is one of the most respected voices in the energy markets. He's got decades of experience calling cycles and identifying where real opportunity is forming. And if you've been watching energy, you know we're at a very interesting point. Fundamentals look tight, most likely getting tighter. Supply has been constrained for years. Capital discipline is finally showing up. So the question is simple. What is the market missing right now? Or am I missing something? I guess we're going to find out. Joining me today is Josef Schachter, president of the Schachter Energy Report and host of the Schachter Energy Conference. Josef, thank you so much for coming on the show today. How you doing?
Wonderful. Yeah. Busy. Just came back from a trip to Toronto. Lots of interest in oil there, institutions, high net worth individuals. So, yeah, it's a we're on the media a lot more than we were 6 months ago.
No kidding. No one was talking about energy a year ago, right? But so it kind of feels like we're sitting at a moment maybe before a big move, either up or down. Fundamentals look a little tight, could be getting tighter. But do you think like the market's fully pricing this in, or is it still skeptical about the supply side of things and the ability to move oil around the world?
I think right now the optimism is that there's going to be a resolution during the month of April. If you take into account the floating storage, Russian floating storage that the sanctions have been removed on, the Iranians able to sell 2.4 million barrels a day of their own oil to mainly China, Venezuelan crude totally under the control of the United States, and they're selling it at world prices. So the volume of oil relative to demand is okay, but it'll be tougher by the end of April, especially in Asia. Already the equivalent price for product in Asia is $200 for WTI equivalent, and that compares to $112 today. So everybody's hoping that this announcement of 45-day ceasefire and a peace agreement and stuff. I don't buy that for a minute. There was three things they wanted when they started. They wanted the nuclear weapons removed. They wanted the terrorism side stopped, and they wanted the IRGC's ballistic missiles not to have any further distance capability. I think the Americans and a lot of the Europeans freaked out when they fired at Diego Garcia, which was like 2,500 miles. And while it didn't get to and hit the airbase there, which is the Americans Brits used, the fact that they could get it to go 2,500 miles was a shocker, because that's the equivalent of every major city in Europe. So, they could hit London, they could hit Paris, they could hit Frankfurt, they could hit, Munich. So there's so many changes that have occurred, and the capabilities. And, we're now starting to hear that China is supporting, not only is Russia, but China is now supporting the Iranians with technology, with ability to be accurate. The fact that they were able to knock out an AWACS plane in Saudi Arabia, a $300 million plane with a drone, tells you that they're getting access to high tech, GPS and coordination, which is a bit shocking. So at this point, does President Trump, not get any of the things he wanted, and does he take Kharg Island and some of the other islands and effectively control the export capability of Iran? Regime change, nobody knows. The regime is even maybe more hawkish than the prior regime. So the key, there's two questions or for people in the investing side to consider. One, do you believe it'll be resolved in April? If it is, then we're in right now we're 112 on WTI. We could go to 120. Like every week, we'll add $2 to $3 to that number. because you start seeing days of inventory coming down. If this goes into May and there is no resolution, there are some people who say that we could see $130 to $150 a barrel of oil for WTI, and product will be allocated and rationed in parts of Asia and parts of Europe, which already there's some countries talking about doing that, and some are doing some product rationing. That would then drive prices much higher. And that would spook the general stock markets. And then a lot of people think that if we see $130 oil for a number of consecutive days, then that would mean that there's a high chance for a recession globally. So, you can't stick your neck out and say, I believe this is the forecast or this is the
Hmm.
forecast. It's a moving target. But what I wanted people to know is that longer term, this means that oil prices will stay higher for longer, simply because days of inventory will come down. Inventories globally on the water will come down, and once the war is over, the amount of oil coming out of the Gulf will not be as high as it was pre-war, simply because of the attacks on facilities that have damaged them. And so the ability to ship the amounts that they were shipping before is unlikely.
Okay, so lots to unpack there. Like, never mind the stock market shock if they started rationing oil and gas. Like, what about like the people in North America? Could you imagine what the people in North America would do if they started being rationed their energy and their oil and gas consumption? Like, this is like Civil War shit, if you ask me, Joseph. I know it won't get, well, hopefully it won't get there, but like, think about that. Like, we've never dealt with that in North America. Maybe in some of these other countries, like in third world countries, and like, yeah, that's maybe a little bit more norm. But throw something on that to the North America, we're gonna have problems.
Yeah, well, if you go to the 70s, we did have that.
Okay,
Yeah,
I wasn't
depending
born.
upon depending upon your license plate, you had even and odd days when you could go and get
Really?
fuel at the gas station. I remember that. My father, would have to check the car and check what day it was before
Really?
he go and fill up. And of course, you didn't want to let your tank down below a half a tank, so you'd go, on the day that you're allowed to go pick up what you needed. But Europe is definitely going to feel product constraints, and Asia is going to feel the same. There's going to be allocations. There's going to be rationing. Prices will, of course, go much higher in those markets, and
Fear.
the pain. Look. We all know already that housing costs have gone up a lot. Education costs have gone up. Healthcare has gone up. So family budgets for the individual consumer out there are getting tighter and tighter, and it's making it more and more difficult for people to live. The high income people, they talk about the K curve, that the high income people are really not being impacted. But if you're middle class or lower income or blue collar, you're feeling the pain right now. And so you're going to have to make decisions of, which bill gets paid when, and, maybe we cut back some of the going out as we used to, maybe for going for dinner, the trading down effect in the restaurants, or not go to movies, not go to theater, all those things. So I think that, we're at that point where you might call it a consumer pinch point, where the consumer is realizing that what I spent my money on pre-March 1st and what I'm spending my money on now, I can't do all the things I did before for my family.
Yeah.
What do I cut out?
Very different. Very different. Yeah, you're totally right. Okay, you talked about energy cycles, like your whole career. Does this one look structurally different given underinvestment in the geopolitical fragmentation than you've ever seen before? Or is this like, yeah, this is like any other war, supply gets constrained, people get worried, oil prices scream, and then once it's over, it's all going to settle down again.
This is like the 74 to 81 cycle. If you remember, there was a war between Israel, the Yom Kippur War in 73.
Yeah,
OPEC was founded. And then at the end, if you remember, Iran came into play again when they deposed the Shah. So, there was a lot of, military and geopolitical issues in that 70 cycle, which I think are again coming to play here. We started with Venezuela, now we've got Iran. And so I think that, it's a repeat of the cycle. Both cycles had underinvestment at the beginning. We then had, some, geopolitical shocks. Then we had a new entrant wanting to buy oil. In the case of the 70s, it was Japan. In the case of the 90s to 2008, it was China. This
Yeah.
year, this time, it's the third world. If we want more copper, if we want more nickel, we want more lithium, we need more rare earths, it's going to come from the third world. Well, they're going to use more energy when that happens. And so that's the big argument why I think this goes into the 2030s. And I think before this is over, we will see the price of crude oil trade above the 147, which is what we did in the summer of 2008. So I'm very, very bullish. I was bullish before. If you remember, I had a pre-March 1st, I was looking for a $70 average when the price was in the 60s because I felt that OPEC would not be able to raise their production in Q2. People finally said there was a 3-4 million, barrel ability by OPEC, which I thought was false, which now becomes very clear it is false. And then the other would be days of inventory coming down by Q4, and I thought we'd see $80. That's all thrown out as of March 1st. And
Yeah.
I think the cycle now is more bullish because of the decline in inventories and how long the war lasts. The longer it lasts, the higher the prices. I think that post-war, we're in a $75, $85 price environment. And I think stocks, will probably see a bit of a correction. Let's say wow, thank God it's over.
Yeah.
U.S. administration war is over. But I think that once that, wherever we go from 120 down to 85 or whatever the number at the high is to get back into the 80s, I think there'll be a stock market correction, but that's going to be a great buying opportunity for investors. Right now, if I look at the whole sector, the bargains are in the natural gas side because most of the natural gas side guys produce 20 to 30% liquids. And so if you take into account that the liquids in Q4 was $59 and now we're 112, if you take 1 month of high prices in Q1 of 2026 and let's assume it's April and May in 2026 of Q2, that's going to add a lot of cash flow on the liquids portion of their business. And I think
100%.
that's where the people don't realize how much cash flow these companies can generate. And what they will do is first, of course, is pay down debt, make sure their balance sheets are pristine. And then right after that, they'll be talking growth because
Dividends,
if the
man.
price is $85, then tier two projects become tier one, tier three projects become tier two, and the drilling industry is going to take off. And that's going to be a whole new cycle. So, the U.S. basin is more tired than ours. They've been drilling it for longer and more intense. So our Montney Duvernay has much more potential. We have conventional liquids that are from that come from that, and then of course we have the oil sands and the SAGD.
Yeah.
So Canada is sitting in an enviable position. The question is takeaway capacity. So you've heard TMX say they're going to do another 300,000 barrels. The 90,000 would be from putting chemicals in to move the oil faster. 300,000 with more pump stations. Then you hear Enbridge talking about some more capacity going south. So we're going to tweak and do whatever we can. But the big thing is, will there be an oil pipeline to the west? Will it go through Alaska? Will it go through BC? Or do we have to consider Churchill again? So I think that Canada, from a resource base opportunity, is sitting in an enviable position. How do we get there is going to be up to the Carney government dealing with the provinces. And that's why our premier in Alberta is pushing for more oil takeaway capacity. I think it's very clear that everybody agrees there's going to be more LNG takeaway capacity. Natural gas going to Asia is a no-brainer because we already have Coastal GasLine. LNG Canada's making the decision now on doubling, from 2 trains to 4 trains, and that would be 4 BCF versus 2 BCF. Remember, that's on an 18 BCF production base right now in Western Canada. And then if all the other projects, the Enbridge, the Cedars, all those others go through, we could be 6, 7 BCF by 2030. You do that on an 18 BCF base, and that's a pretty big growth rate. And then there's more projects that come on simply because of what happened in the Middle East, where people say, hey, Qatar's a nice place to buy natural gas from, but we need security of supply. And if you're in
100%.
Asia and you look at the days of transportation from Qatar to South Korea or Vietnam or Thailand or China, versus from Vancouver or the BC coast, BC coast wins.
Yeah, 100% every time. Okay, a lot to unpack there too as well, but I did want to make a funny little thing. I remember the day that oil hit 147 because the CIBC analyst was on BNN calling for like $225 oil that day. And I remember sitting there going, oh, that's really bullish, really, really bullish. And sure enough, it was the top. Anyways, that's a little side note. Has any of the get like the any of the oil producers been able to start reporting based on these increased WTI prices yet? Like, does the market even understand the kind of numbers and the cash flow that they're going to start pushing out?
Analysts are starting to do that for the U.S. companies. U.S. companies will report Q1. Again, March, the end of March was the quarter. So third, fourth week of April, you'll start seeing the beginning of companies reporting, and they'll talk about the 1 month, the March month, which was which could be $100, and then wherever we are, they'll get a lot of questions on the Q&A of their conference calls. So, we're into, late March, we're into late April, we're into May. What is that doing to your cash flow? What are you doing with that cash flow? And I think people will be shocked by how big the cash flow changes are unless the company's hedged a lot of it away at lower prices. But if they didn't hedge it and they're getting the benefit, people will realize how leveraged the industry is, because it's a very high fixed cost, low variable cost business. And so the business, because you have pipelines, you have facilities, you have batteries, you have transportation. So you add all of that in. So you have that if you're producing 20,000 BOEs a day or 30,000 BOEs a day, or if you're getting $60 or if you're getting $100. So I think that people will see the leverage when they see the Q1 reports. And then I think if this lasts into April, May, they're going to see the leverage. And I think that the prices of these stocks, many of them are trading, at 1P RLI, proven reserves. They used to trade at PDP, proved, developed, producing, which was a much lower number. There are still companies trading at PDP, so there are Canadian companies that are very cheap. And then there's a lot of companies that are trading at the 1P. Historically, at market peaks, you trade at 2P. But that number is 2 to 3 times what it is today. And it goes up even higher if the commodity price goes up. The engineers then give a higher value to the reserves. And then if a
Of
company
course.
drills and brings on more reserves, then you get a higher price for that. So there's a big multiple expansion still to come, which has not happened yet. The other thing is the cash flow numbers. As I mentioned, the higher commodity price means higher cash flow. Higher cash flow, you get a higher multiple as the cycle unfolds. And then, of course, if you're increasing production, then that generates more cash flow. So if I was to look out there and say, E&P companies that are growth, that are medium size or smaller, there could be a lot of 5 and 10 baggers out there. The big companies like C&Q can't grow that fast, but they'll benefit from the higher commodity price. So there's, owning C&Q and Suncor makes sense for conservative accounts. You get a not bad dividend, but the upside for individuals who want to make total returns, dividends, NCIBs, and stock performance, the medium and smaller companies are where we think the action's going to be in the cycle. And we cover 32 companies. We cover some in the service sector, but we cover a couple of royalty companies for the conservative investors where there's 5% dividend yields and you can make 10-20% capital gain. That's a great return for a
Hmm.
conservative investor. But then for the more entrepreneurial investor, we think there's 5 and 10 baggers out there between now and the end of the cycle. So it's 2026 or 2030 is not that far away, and if you can make 5 baggers or more, that's got to be of interest to
Yeah.
investors.
Okay, so if I want to list those names, what is it going to cost me to get your subscription service? Because I know you only give those names to people that pay you for your research, and your research is very good. So what does that cost? What does that cost?
Well, we have a regular annual is $9.99, but for people listening on this podcast, and because we're trying to grow our subscriber base, whenever we have a podcast with people that we've worked with and we like, we do $100 off. So when you go through the checkout,
Okay.
the website is www.schachter, SCHACHTER Energy Report.ca. When you check out on buying the subscription, at the bottom you'll see a promo code before you check out, in that promo code, put POT 100, POD 100, and you'll get the $100 off because of the podcast. And we'd love to have more people join us. We cover companies as large as Tourmaline, which is 600,000 BOEs a day, and we cover companies down to 2 or 3,000 BOEs a day that are high growth. So people can then pick what fits their need. If they want dividend income, we have companies with decent dividend incomes. There's still companies yielding 5-6%. Like, I can give you some numbers. Freehold Royalty 6.1%. You've got Marin Energy, a 9% dividend yield. Alvo Petro, a 6% yield. Surge Energy, 5.9. In place, 6.2. Petra, 6.5. So if individual investors want to have yield, they can get some yield. And if they get a 10% gain in the stock or more, then they're home. Then they've got a total
That's
return
amazing.
that's fabulous.
It's amazing. I always laugh at the people that like aren't willing to pay for good research. Like, come on, like you're putting the amount of money you're putting into some of these companies, and you're not willing to pay like $500 or $1,000 for a year for someone to feed you some really good quality ideas for you to sift through yourself. It just blows my mind. Like,
Yeah,
there's
like
real value there, right?
all they need is
Just one.
one idea that we
Yeah.
give them that they buy that fits their investment needs. And again, the investors, either some of them manage their own money, others work with their money manager. But if they look at the research and see something that fits their pistol, go talk to your money manager, get your investment advisor on side, and then bring it in your portfolio. And if it works out well, then it's worth it for the subscription. And we've been at this for quite a few years, and
Yeah, you totally have.
we cover 32 companies right now. Our last major buy signal was April of 2025, and I think from there, if you just pull out any chart of any company, you'll see how wonderful
Yeah.
how the stocks have done.
Yeah.
But I'm thinking that right now the bargains are in the natural gas sector. But I think if we have the war over and there's a pullback, then it would be the next great buying opportunity. So get your buy list together, and if you want, dip now and start buying, a dollar average in, buy a third now, buy a third on the correction, and
Scale
then
in.
build your portfolio. We've told people to move in on a buying level, and we told people, in April, go to 80% invested, whatever your appropriate weighting is for energy. If you're in Alberta, that's going to be higher than it's going to be in Ontario. But the reality is, you need to have some energy because we all use it, we all consume.
100%.
And if it's going up in price and your utility bill goes up, why don't you hedge that by buying stocks that are benefiting from that higher energy price? It's only, common sense that, if you're getting pushed up here, own something that's going to go up here that's going to offset it.
Yeah. Well, I was at your conference last year with my client Ken Cambria, and then you turned me on to the Bonterra. Like, and that's been just a great win for me. So thank you. That's been a very good name. Now they're in the Monterey Duvernay, right? Is that right?
They are in the base business is the Cardium,
Okay.
but they have a growing business in the Charlie Lake and a
Okay.
growing business in the Montney. Bonterra is a great name. We own it as well personally. The family here owns it. I own it, and we think it's a great story. And there's so many names that are still bargains. For example, I'll give you just some of the stats for Bonterra. Bonterra is 54% liquids, 15,254. So it's a nice sized company, $238 million market cap, trading at 27,000 a BOE, and that should be 50,000 a BOE. But we have the net asset value at 2006, and the stock is trading at 660. And we have the recent our NAV at the end of 2025, based on low commodity prices. Remember, we were under $60 at the end of the
Yeah.
year, was 1446. So it's not even trading at half of its NAV based on depressed commodity prices. So, we think those stocks are kind of the bargains. And, as you said, you bought it and it's worked out well. And I have, the lists we have, and here it is.
Yeah. It's a big list.
We've got, you decide what you want to own, oil or gas or both. Do you want dividend income? Just go through the pages, coverage list and valuation. You can find lots of good ideas. Go to the websites, look at their presentations, do your homework. If you're going to buy a car, you do your homework. If you're going to buy any appliance, you're going to do your homework. Do your homework, go to the website, see the presentations. Many of the companies have quarterly conference calls. Listen to those. Some of them even do podcasts, and you can listen to those. So the more informed you are, the more comfortable you'll be. And then lastly, as you said, come to our conference because most of these companies will be there. And how often does an individual investor get a chance to talk to the CEO of the company and ask them whatever questions they want, go to the presentations, spend time at their booth? That kind of interaction is not available anymore except to the institutions. So we kind of filled the vacuum by creating the Catch the Energy conference. That'll be held in Calgary Saturday, October 17th at Mount Royal University. And so I think that people should keep up with our website on it. And please come to the conference. Everybody who is a subscriber gets 2 free tickets to come. So there's an added incentive there. And please come and please come and come and see me. Please come and see my team at the conference. We have a booth as well, and I think you'll find it very, very beneficial. And the momentum of the stories, because people are coming to it. People are saying, "Hey, this is the first time I got a chance to talk to the CEO of a company I own." And I heard the story and I love it. I'm gonna stay with it. I'm not gonna trade it.
Well,
I believe the cycle and I'm gonna stay with it. And
yeah.
that's where you get the 10 baggers.
100%. Well, there's not a lot of energy conferences out there. Like there's a couple kicking around the States that I've never gone to, but like I think you're like the bread and butter for Canada now. Like if you're an oil and gas company and you're not at your conference, like come on, you're missing out a really big opportunity.
People should be coming, because we cover the biggest companies and the small, and
Totally.
TMX has us with the energy industry of tomorrow. So the lithium stories, the battery stories, like the rare earth stories, like all the things that are going to be mattering for the energy industry of tomorrow are also covered in, and we have TMX has 2 rooms that they're the major sponsor. So there's a lot of companies coming that are not just E&P or
Yeah, yeah.
service industry or royalty. And I think people should come because, number one, you want to be in the sector, but you may want to be in the technology side of the sector or the emerging part of the energy sector, uranium, all the things that are going to be that are part of energy, but maybe not the E&P, which is my specific talent.
Yeah. Okay, so to be a devil's advocate, and just so people know that like this isn't like a paid programming here, we're just here to pump your tires. You're an oil and gas expert. How much of an expert are you on lithium and uranium and some of these up and coming kind of alternative energy situations?
I'm not an expert, but I know that we need them and there's a shortage. I do own positions in my personal portfolio in uranium. I'm looking at some of the other areas,
Okay.
but if you said when you on your energy portfolio, where are you? I would say 90% plus is in
Okay.
the conventional world that I know that I've from the 70s when I started in the business. But like anything, we all want to have something that's a little more entrepreneurial and it's a smaller portion of your portfolio. And instead of, let's say, 5 to 7% positions that I'll have in E&P, I might have a 2% position in some of this other stuff. So if I'm saying that, I'm 90% in there, so it means I might have 5 positions, 2% positions where I'm saying, look, I know uranium is real. I know that Canada's, Saskatchewan is a great place, and so I've got to be there. And I've got to be looking at other areas in the technology side of the industry. The grid has to be replaced, so we've got to spend money on that. Data centers are real, and we have cheap natural gas in Canada, so people should be looking at all these different areas because all of them make sense. And if you're a conservative investor, try to find a pooled fund that does it. If you are somebody who wants to own names and wants to meet the company management, come to the conference and then see the names, get our research. We are, there's a lot of, individuals covering smaller, like really junior names with very little revenues, like more of the venture capital world. That's not my world. I want balance sheets. I want companies that have, strong balance sheets. I want companies with management owning a lot of stock, and I want them to have bought it, before me
Yeah.
at prices that I think are reasonable. And so then I can say, okay, if they pay 250 for the shares and the stock's trading at $3, because of what's
Yeah.
happening with the price of oil, that's not a bad price to get in.
Yeah. I pound the table to all my listeners, like get to know the DNA of these companies, right? And truly the only way to get to any of the DNA of these companies is to meet these guys face to face. So
Yeah.
you got to take the time. And it shocks me like the amount of money that people invest in these companies and they don't make the effort to take a weekend off somewhere along the year to go to Calgary or to Vancouver or to Toronto to actually go meet these teams that they have their money with. It's,
Yeah.
it's wild, wild. Okay, so one thing I remember talking to Adrian Day last year, once all these gold stocks had gone like way higher, gold was trading way higher. He was talking about, well, in fact, the gold stocks are cheaper now, even though that they've run 300% than they were when they were down there. Do you see that here based on like a PNAV level, like where oil prices are now, like all the valuations of these companies are still cheaper than where they were 6 months ago?
I would say not for some, but not for all,
Okay.
because remember the commodity price is going to generate maybe 70, 80% higher cash flows. So the stocks that have only gone up by 30%, they would be cheaper than they were, before March 1st. But the key thing is to remember if we are going to go to, if the market is going to get to, 170, 180 before the end of the cycle, and the market's going to discount and pay 120 in the numbers, like when you were talking about 147 in 2008, the market was discounting about $100 oil in the stock prices based on the price to cash flow, price to NAV, price to all that. So to me, I think before this is over, we will trade at a higher level, and that Canada, which had a discount because of our prior political leaders, will get a premium because people will want us because of security supply and the fact that we have a very long reserve life index. Like think about the oil sands, 50 years of reserves. Think about the natural gas companies that are providing natural gas to the LNG, 25, 30-year reserve life. You don't have that in the States. And so to the same degree that you have in Canada, and our basins have not been as drilled up. So people, wherever you are around the world, Canada is a place to be for investing. It doesn't mean that, you shouldn't own, big American companies if you live in the States and you know them. But, everybody should consider having something in Canada simply because of the attractiveness of our basin.
Especially because Joe Rogan's on our side now too, and he wants to see our he wants to see our oil sands develop now that he knows that it's clean. That was awesome. Way to go, Polivier. Okay, so do you think like what happens needs to happen for institutions to like really reweight meaningfully in the energy sector again? Do you think they're there yet? Like the generalists?
Well, I think in the last few months, if you watch BNN, you're seeing more and more people plugging oil stocks or energy-related names in their top picks at the end of the show of market calls. So that's changed, and generalists are doing it. There was always the one mutual fund, the big one, the oil fund in Toronto, Eric Nuttall's fund.
Yeah.
And he was the one really carrying the ball on BNN. As a believer in the energy sector, but now you've got generalists talking about it, and they're recommending the big boys, CNQ, Tourmaline, all those,
Because
and
it's
then getting
easy.
some
Yeah.
that are
Yeah.
recommending, going down to the Bonteras, the Cavies. There's so many great names out there. It's like being a kid in the candy store. I want this, I want that, I want this. And from my point of view, is we own my wife and I own 11 names. Well, how many more can we own? We can't own 20 or 30. So you've got to fine tune it and say, I really believe this company is going to be a home run for me, and so I want dividend income. So I have conservative names that develop that, but I also want the growth names, and so I have a mixture of both conservative growth and entrepreneurial. And if the 11 names do what I think they're going to do, then the total return from my energy portion of my portfolio will have justified being so supportive.
You can't kiss all the girls, can you, Joseph?
We
You-
we may have tried
We
in
may
our
have
20s and 30s,
tried.
but I'm push.
As we get wiser and
I'm
older.
multiples of that now.
Love it. Love it. Okay, you talked about natural gas being maybe a place that you want to look at because it got a percentage of liquids that's not really accounted. But like natural gas in North America is super volatile and frustrating. Like, how do these guys make money? Like, A, at $3 or $2 or whatever it is. And is this a structural opportunity or a trader's market? Like, what do you think?
I think it's structural because of the LNG exports. I think, and also the fact that people realize that natural gas is the interim fuel. It'll take time for small modular reactors to be built so that we have nuclear power. Germany's reversing their stance and closing their coal mines. They're opening them up again, and coal-fired facilities. You've got Japan and Germany reversing everything from the uranium side, so that the nuclear plants are going back up. So I think people realize that the shortage of power is going to be important, and you got to resolve it. If you want AI and data centers, you got to have the grid build for that. For normal customer demand from individual consumers, you've got to grow the grid. A lot of the grid is old, needs to be replaced, needs to be upgraded, needs to be able to handle more power. So all of that whole area is an attractive potential for individual investors. And I think natural gas is in Canada right now, it might be a buck 30. It's terrible.
It's
The
terrible.
industry probably needs a buck 50 to break even. So, we need the LNG plants taking off. We need to see, the opportunity expand like we think it's going to. And if it does, I think we're going to see, $3 gas. But the key thing is every company that's a natural gas producer might have 15 to 25% liquids, and the liquids are going to pay the bills right now in the near term. But if we get to $3, $4 gas, that's going to be very profitable. Look, if you have a buck 50 input and you're making three, that's a nice margin.
Yeah, yeah, yeah. So why is gas in Europe trading at like 18 bucks over versus like
Because they
Canada?
don't have their enough. They're Germany and the Netherlands. Norway have some, but they've got to import. They've done long-term contracts with Qatar or Australia or Papua New Guinea, and so the price for TTF, which is the European price, is can be at times when everybody was worried about more attacks on Qatar, it was trading at $50. So
Saw
US.
that.
And the U.S. price might have been 3.5, and Asia was probably 12 to 15. So remember, the gas you buy the gas in the States, you have to liquefy it, then you have to transport it, then you have to put it in the system. So there's probably $5 to $7, which are the incremental costs. So if you take U.S. price of 3, add 7, that's 10. Well, if you're getting 18 or 25 in Europe, that's great. And if you're getting 14 in Europe, in Asia, that's great. So that's really the key, is if we can get mid-teens in either market, and the total input is under 10, then it's the price at the wellhead goes up a lot.
Hmm. Okay, and like I just signed on a helium producing client, Joseph. And by very fortuitous timing, like the stock's tripled. What's going on in the helium market like right now? I see news about Qatar and lack of production in North America. Do you have any insight on helium?
Yeah, helium is needed more and more. It's like what we saw what happened with memory. All of a sudden, Micron and everything just took off when everybody realized the AI craze is not just NVIDIA, it's memory too.
Hmm.
People realize that helium is part of the process for making semiconductor chips. So all of a sudden, it got caught up in the AI craze. And anybody who's got helium not in the Middle East, in the Gulf of, in the Persian Gulf, is making out like a bandit. So a lot of companies had helium in inventory. The big gas companies in that business, so they're going to make lots of money on their inventory if they haven't contracted it already. So if they have spot markets there, the other one that people should remember is sulfur. Sulfur was trading in the 30s. 60% of the sulfur comes out of the Middle East because of the natural gas there. And you've got a company called Cavi in Canada, CVVY, which is a big producer of sulfur. And the spot market now in Vancouver is 600, and they have contracts for part of theirs at 200, but remember that's up from 38, and then a third of it is open at at higher prices, which are 500 600 at spot, and that's going to generate a tremendous amount of new cash flow for that company.
Wow. Oh, actually, that actually brings up a question: is like, do any of these producers dare to hedge at these prices?
Well, you can't hedge at a buck 30, buck 50. You'll go out of business real quick.
Oh, I'm talking
So
about
they're
like oil in
trying.
the oil market. Sorry, like I switched
Oh,
sides
the
there.
problem
Sorry.
is you're looking at the front month having the high prices, but then if you go into, let's say, December of 2026, you might be $70. So we have a very, what I think is going to happen is the back end, where backwardation is the word, the back end is going to go up in price over time. Like when war ends and people realize we're in an $80 price environment, the curve will go not from high end 120 down to, or 112, let's say down to 70. We might see the front end of the curve be 80 or 90 and the back end of the curve be 70 or 80, and move up. So I think we'll see a flattening of the curve once the war is over. But the key thing is the curve is going to be higher simply because of the destruction that's occurred and the fact that security of supply will come back into vogue. And people will realize OPEC does not have so the ability to raise production materially. It's going to have to come from other places around the world. One of the stupidest things that you can imagine is the Norway North Sea is growing in production, and the UK North Sea is no different geologically, and yet the British government won't allow drilling. Like, how stupid can you be?
Or
You'd
yeah.
rather go and import it from the Middle East than have it as your own. And the UK North Sea has a lot of potential. And there's no question about the industry knowing how to handle the environment and make sure you drill properly and the rest of it. We've been doing it, in very difficult places, be it Brazil, salt domes. We've been doing it in the Arctic, Alaska. They know how to drill in the North Sea. Norway does. So why the hell doesn't Britain get their act together?
Well, yeah, that's a long conversation, right? But you take disasters to learn from things, right? But you take those disasters and you set rules to make sure disasters don't happen again. But those disasters are where you learn and you become better and you stop making those mistakes and you be able to advance these things properly without making the same mistakes. Like, look how far nuclear technology's come. Like, it's just
Yeah,
incredible, right? Like,
yeah.
and like the benefits of it are insane. Wow, we've gone 40 minutes here. I could keep talking to you, but we're gonna just end it with a couple more quick questions here. What's the one mistake investors keep making in energy over and over again?
I think it's not knowing your companies well enough, because I think what happens is, they see the price might pop for 30%, and then they take the profit off. They've got to know that, know the companies, know the assets, go to see the presentations and see. And here's an easy one for them. Pick your favorite stock that was around in 1999 to '08, CNQ or whoever. Look at what the stock did from the beginning of the cycle to the end of the cycle. There's corrections along the way. So what you want to do is take advantage of the corrections. There will be one again. We had one in April of 2025, March, April, from the beginning of the year. Once the war is over, we're going to have another correction like we normally do, and take advantage of those and add to positions on those weakness periods. So what I want people to do is know your company. If you say to me, what is the most important thing, is know what you own. It's, you do
It's
it
your
when it's a
DNA.
car,
The
you do it
DNA.
when you're on computer, you do it whatever you're doing, you spend time on it, spend time on your investments. That's your retirement, and know that, and then be patient. And when I look at companies and I look at my success over the cycles, it was, even though I saw other names moving, the names that I thought were really good, I stayed with. And all of a sudden something happens. They do something, they have a great well, they have a great new play. The price of the commodity takes off. Somebody knocks on the door to take them over. You don't know where the serendipity is going to come from, but that's where the 10 baggers come. Like we were, very big investors in a couple of companies that got taken over last year. Like, last year, New Vista got taken over, Coedno got taken over. The year before, Tourmaline took over Crew. Last year, Whitecap took over. Let me see what the name of the company was. But there's always takeovers that are occurring, and if you own those names, you're sitting there saying, "Wow, that was really nice." Like Whitecap took over Varen.
Patience. I heard the
Patience,
word patience in there. Patience and conviction. And you get your
yes.
conviction from the DNA and getting to know your companies you're investing in.
Yes. And if you have questions, come to the conference and ask the company executives, and that will give you the ability to be patient and let the cycle unfold. We are
100%.
going to see in the industry go from 3 times cash flow to 10 times cash flow. We're going to see the industry go from $112 to maybe 160, 170 at the end of the cycle.
Yeah.
We're going to see natural gas go from $1.40 for ACO to $1.30 to $3, $4 ACO. All of that kicks in with more cash flow, which means higher and higher valuations.
Yeah.
And so I would say to people, what you got to do is, one, you want to be comfortable with the people in the company, that they've done it before, that they've done success, Mike Rose at Tourmaline did it at Berkeley, then at Duvernay, and now at Tourmaline. Second, you want the plays. You want them to have plays that are large enough that they can increase the value for the shareholders over time. And then you want their money in there before yours. So you want them to be big investors. You don't want them to be bureaucrats taking a big salary and bonuses. You want them having their net worth on the line. And that's what we do is we look for it. We
I
write an
love
insider trading
that.
report all the time. We'll be doing one at the end of April again. We do them quarterly. So you can see what management owns. And what you want is management owning a lot of paper because they're working then as shareholders. They're not working there for the check, the payday from salary and bonus.
Oh, from shareholders' capital.
Yeah.
Other people's money, right?
Other people's money,
Yeah,
yes.
right. Like, come on, come on. That's a great interview, Joseph. Thank you so much for your time. We'll get all your info at the bottom of our podcast or whatever we call it. Um, and to make sure that we can either get your newsletter signed up for or be at the conference. And for my listeners, I will certainly be at Joseph's conference. So if you see this little face in this ugly mug, make sure you shake my hand too as well.
And come by the booth, and I'll look forward to meeting with you
Yeah,
again.
yeah. Right on, Joseph.
And
Thank you.
again, thanks very much. And again, people can just go to our website and take advantage of the Pod 100.
Yeah, perfect. Thanks for your time.
Thank you as well.
Yeah.